Every day the value of the Indian rupee changes, sometimes only by a few paise. Sometimes much more. You hear headlines like, "The rupee hits a new low. The dollar becomes stronger." But have you ever stopped to ask? Who decides the value of the rupee? Is the government lowering it? Is the Reserve Bank printing too much money? Or is something much bigger happening? The truth is, the value of a currency is influenced by millions of decisions happening every day. Businesses importing goods. Companies exporting products. Foreign investors moving money. Central banks adjusting interest rates. And ordinary people traveling, studying, and shopping. Today, we're going behind the headlines to understand why the rupee keeps falling and what it really means for India. Chapter 1: What gives a currency its value? Imagine two friends. One has apples. The other has oranges. If more people want apples, their value rises. Currencies work in a similar way. The rupee is also something people buy and sell. Every day, banks, companies, governments, and investors exchange currencies. If demand for the rupee increases, its value usually rises. If demand falls, its value usually weakens. No single person decides its price. Instead, it changes continuously in the global foreign exchange market. This market trades trillions of dollars every day. Like any market, supply and demand determine the price. But why is there often greater demand for dollars than rupees? Chapter 2: Why the dollar is so powerful. The US dollar is the world's most widely used currency. Many countries use dollars to buy oil. International trade is often settled in dollars. Global companies borrow in dollars. Investors hold dollars as a relatively safe asset during uncertain times. Now imagine India importing crude oil. Indian companies must pay suppliers in US dollars. So they first exchange rupees for dollars. When many businesses need dollars at the same time, demand for dollars increases. If the supply of dollars doesn't keep up, the dollar becomes more expensive. Which means, the rupee buys fewer dollars. This is one of the biggest reasons the rupee weakens over time. But trade isn't the only force moving currencies. Chapter 3: Money travels across borders. Every day, billions of dollars move between countries. Foreign companies invest in India. Global investment funds buy Indian stocks and bonds. When foreign investors bring dollars into India, they exchange dollars for rupees. This increases demand for the rupee. But during uncertainty, many investors move their money back to safer markets. They sell Indian investments, convert rupees back into dollars, and leave. As demand for dollars rises, the rupee can weaken quickly. Interest rates also matter. If US interest rates rise significantly, some investors prefer keeping money in the United States. Capital flows toward higher returns. Currencies respond. Can India stop the rupee from falling? Chapter 4: Can the RBI save the rupee? The Reserve Bank of India watches the currency market closely. Sometimes, it sells US dollars from its foreign exchange reserves. This increases the supply of dollars, helping reduce extreme volatility. Sometimes, it adjusts interest rates. Higher interest rates can attract foreign investment, supporting the rupee. But no central bank can completely control currency markets forever. Because exchange rates reflect global trade, investment flows, inflation, economic growth, and international confidence. The RBI can influence the market, but it cannot eliminate market forces. Chapter 5: Is a weak rupee always bad? Many people assume a weaker rupee is always bad. The reality is more complicated. Imports become more expensive. Fuel prices can rise. Foreign travel costs more. Studying abroad becomes more expensive. But exporters may benefit. Indian software companies. Pharmaceutical firms. Textile manufacturers. Businesses earning dollars may receive more rupees when converting their income. A weaker currency creates both challenges and opportunities. What matters most is whether the economy remains productive and competitive over the long term. The value of the rupee isn't decided by a single person. It's shaped every day by trade, investment, interest rates, global events, and millions of financial decisions happening across the world. The next time you hear the rupee has fallen against the dollar, you'll know there's much more behind that headline than a number on a screen. You'll be looking at one of the world's largest financial markets in action. If you enjoyed this documentary, subscribe for more videos explaining finance, investing, business, and economics in simple language.